Welcome back to Self-Invested. I'm Lemuel, and in today's video we're going to be talking about paying off credit card debt fast. I'm not a financial advisor, I'm not an expert, I'm just a regular guy trying to educate himself on personal finance and share what he learns along the way. So in this video I'm going to be covering the problem with minimum payments on credit cards, paying off multiple credit cards directly, using loans to pay off multiple credit cards, and lastly, moving debt to a cheaper credit card. As you would expect with one of my videos, there's going to be loads of examples to try and explain ways that you can pay off your debt. So the first topic I'm going to discuss is the problem with minimum payment. So firstly, what is a minimum payment? Well, a minimum payment is the minimum you must pay back on a credit card in order to avoid additional charges. Now, the minimum payment is usually in the UK sort of 1% of the outstanding debt plus that month's interest, or 5% or £5, whichever is greater. The problem with sort of making the minimum payment is that it's going to take you a long time to pay off your debts, and also it's going to cost you a lot in interest. So if, for example, you had a balance of £5,000 on a credit card with an APR of 18.7%, so that's 18.7% interest over a year, and you only made the minimum payments until you cleared the debt, it would take you 32 years to pay it off and cost you £7,595 and 41 pence in interest, in addition to the initial £5,000 to pay off. That means in total you would have paid £12,595 and 41 pence to pay off an initial debt of £5,000. The reason that it's so expensive and it takes so long to pay off is that although the minimum payment covers the interest on the debt, it's only reducing the outstanding debt by 1%. And so every time you reduce the outstanding debt, the repayment that you make gets smaller. So in that example I just gave, the first payment you would have made would have been for £127.92. Now, £77.92 of that would have gone to the interest incurred on that first month, but £50 would have gone to actually reducing that debt from £5,000 to £4,950. But the second minimum payment that you make in the second month would have only reduced that debt by £49.50. Just in 1 month, the amount that you've reduced on your debt has gone down from £50 to £49.50. Each month that you pay off your credit card debt just by paying the minimum, you're going to actually be paying off less and less. By the 70th payment, which will come 5 years and 10 months after the first payment, the repayment that you make with the minimum payment will only reduce your outstanding debt by £24.99, which is half the amount you reduced it by with that initial payment in the first month. If you, on the other hand, were to pay the same amount as you paid in the first month, so that would be £127.92 across the life of the debt until you paid it off, which, because you're able to sort of pay it off initially, it's very likely that you could set that money aside to continue paying it off until you clear that debt. It would take you 5 years and 1 month to pay it off, and it will cost you only £2,770 and 74 pence in interest, which is over 4,500 less in interest than just making a minimum payment, and 27 years quicker to pay it off than if you were just paying it by the minimum payment. So that example I just gave sort of illustrates the reason why it's better to sort of pay off your credit cards quicker than just by the minimum payment, because in the long run it's going to cost you more money and it's going to take a lot longer to actually pay it off. The first example I'm going to look at in terms of paying debt off fast is just looking at sort of paying off your credit cards without moving the debt elsewhere. Just focus on paying off the credit cards that you have with the credit card providers that you have. Now, the quickest and cheapest way to sort of pay off your credit cards is by paying off the highest interest first. It's not going to be by paying off the highest amount first. This is because the debt with the highest interest is going to be the most expensive. The higher that interest rate, the more you're paying on that debt. If we have an example of 3 different credit cards, let's say the first credit card has 5,000 on it and has an interest rate of 18.7%. The second credit card 2, has an outstanding balance of 3,000 on it with an interest rate of 24.7%. And the third credit card has an outstanding balance of £2,000 and an interest rate of 12.4%. The quickest way to pay off those credit cards would be to pay off credit card 2 first, because it has the highest interest rate at 24.7%. Pay off credit card 1 second, because it has the second highest interest rate at 18.7%, and pay off credit card 3 last, because it has the lowest interest rate of 12.4%. Now, just to show you how much quicker and cheaper it is to tackle the debts in this way, I'm going to compare paying off the highest debt first, the highest outstanding debt, so that's credit card 1 first, and then paying off the second highest credit card 2 second, and then paying off the lowest credit card 3 last. And I'm going to show you how that compares to actually paying off the debt with the highest interest down to the lowest in that order, just to show you how much cheaper and quicker it is. So for the sake of simplicity, in the examples that I'm about to go through, I'm going to assume that you can focus on paying off one credit card without touching the other ones. You'll see what I mean sort of shortly, but in reality you can't do this. You need to at least pay the minimum payments on all of the cards, otherwise you're going to sort of face a penalty charge for missing a minimum payment on your credit cards. But I'm just sort of assuming that you can do it in these examples for the sake of simplicity. Let's look at the first example, which is paying off the highest balance first and the lowest balance last. Let's assume you had £200 a month available to sort of pay down your credit cards. So if you had £200 available a month to pay down your credit cards, and you were to use that to pay off credit card 1 with the highest outstanding balance of £5,000, it would take you 2 years and 8 months to pay off that credit card in full. And over that time, it would have cost you £1,384.49 in interest. By this time, the interest on credit card 2 would have increased by £2,758.01 to a total outstanding balance of £5,758.01. And over that same period as well, credit card 3 would have increased by £779.07, and taken this total outstanding balance on credit card 3 to £2,779.07. If you then use the £200 to pay off credit card 2, the credit card with the second highest balance at £3,000, it would take you another 3 years and 9 months to pay it off, and cost you an additional £3,056.62 in interest. By this time, the interest on credit card 3 would have increased to £1,634.71 and taken the total outstanding balance on that card to £4,413.78. Finally, if you use the £200 to pay off credit card 3, it would take you another 2 years and 2 months to pay it off and cost you an additional £621.81 in interest. So in total, it would have taken you 8 years and 7 months to pay off all 3 credit cards and cost you a total of £10,734.70 in interest. This is in addition to the initial outstanding balance of £10,000 of the credit card. This £10,734.70 is the cost of actually having those credit cards. It's not the actual balance that you've been paying off. So now I'm gonna look at how long and how much it would cost in interest to pay off the debt with the highest interest first, and the lowest interest last. So the debt with the highest interest is credit card 2, which had an interest rate of 24.7%. If we use the £200 available each month to pay off that credit card first, it would take 1 year and 7 months to pay it off and cost £624.91 in interest. Over this time, the interest on credit card 1 would have increased the outstanding debt by £1,707.58 to a total outstanding balance of £6,707.58. Also, the outstanding debt on credit card 3 would have increased by £431.41 and taken the total outstanding balance on credit card 3 to £2,431.41. If you then use the £200 to pay off credit card 1 with the second highest interest rate at 18.7%, it would take you another 4 years to pay it off and cost you an additional £2,856.90 in interest. Over this time, the outstanding debt on credit card 3 would have increased by £1,551.16 to a total of £3,982.57. If you then used the £200 to pay off credit card 3, it would take an additional 1 year and 11 months to pay off the credit card and cost you £499.59 in interest. In total, it would have taken you 7 years and 6 months to pay off those 3 credit cards using that method, and a total of £7,671.55 in interest. This means the second method, where we focused on paying off the highest interest first instead of the highest outstanding balance first, would have cost you £4,824.67 less in interest, and would have been over a year quicker. So this method of paying off the credit card with the highest interest debt first and the lowest interest last is known as the avalanche method, and is the quickest and cheapest way of paying off debt without moving the debt elsewhere. So in addition to the avalanche method, there's another method of paying off debt known as the snowball method. Now, with the snowball method, instead of focusing on the credit card debt with the highest interest and paying that off first, you focus on the debt with the lowest outstanding amount first, and you pay that off, and then you work your way up to the debt with the highest outstanding balance. So the reason people advocate for paying off debt in this type of way is because it helps people stick to paying off their debts psychologically, because it's the quickest way to pay off one of your credit cards or one of your outstanding debts. It's the quickest way to get you a win, and that can help sort of motivate you and give you belief that you can actually pay off the rest. So that's the reason why people sort of advocate for the snowball method. So with this example, it would mean sort of paying off credit card 3 first, because it has the lowest outstanding balance of £2,000, then moving to credit card 2, which has an outstanding balance of £3,000, and then move into credit card 1 last, because it has the largest outstanding balance of £5,000. Now, just to show you how much quicker it would be using that method to pay off your first credit card, if you use £200 to pay off credit card 3, it would only take you 11 months to pay off that debt, compared to the 1 year and 7 months it took you to pay off your first credit card with the avalanche method. So you can see sort of in that example how that difference in sort of paying off a credit card quicker can actually help sort of motivate you by seeing that win quicker than the avalanche method, where it would take you an additional 8 months to actually pay off your first credit card. To be honest, I think the best sort of method for paying off credit cards, whether it's avalanche or snowball, is by using a method that you're more likely to stick to. If you know that you need a quick win, that you've been sort of struggling paying off your debt, maybe the snowball method will be sort of better for you, because you'll get that first win sort of quicker than you will with the avalanche. Even though in the long run the avalanche will be cheaper, it's going to take longer to sort of get that first win. But if you think you can be more focused, and you know that you can stay disciplined, and you'll, even if it takes a long time to pay off your first credit card or your first debt, you'll sort of stick with it, then going with the avalanche method is going to be the quickest and sort of cheapest way to pay off all your debts. Just to reiterate, with the examples that I gave, I was just focusing on paying off one credit card and not sort of paying any amounts on the other credit cards. In reality, you can't do that. In reality, you have to sort of pay the minimum payments on the other cards. But what those examples were showing you was that if you'll make the minimum payments on all of the cards that you have, but any additional money that you have for paying off your debts, you'll put towards the credit card with the highest interest, or the lowest outstanding balance, and you focus on that debt until it's paid off. Then you move to the next one, but all the time paying the minimum outstanding payments on your credit card, so you don't have to pay any unnecessary charges or get penalized for missing a payment. So a quicker method of paying off the credit card debt from the last examples could be by getting a loan. Now, if you were to get a loan to pay off your credit cards, you would need to have decent need to have a decent credit rating or credit score. If you have a poor credit score, then it's likely that any loans that are available to you are going to have interest rates just as high as your credit card debt, and not really going to be a beneficial sort of method for you to use. But if you have decent sort of if you have a decent credit rating, then getting a loan to sort of pay off your credit cards could actually be a cheaper method than just paying off the credit card debts directly. Now, I had a look online to see how much it would cost to take out a £10,000 loan. So the total outstanding debt on the credit cards in the example I gave before was 10,000. So if you were to take out a £10,000 loan with a monthly repayment of around £200, I found that if you have an excellent credit rating, you could get a loan of £10,000 with an interest rate of 2.8%. Now, if you were to pay this off over 5 years, it would cost you £178.64 a month, which is quite a bit less than £200 a month, and would cost you in interest £718.59 in interest. Compared to the avalanche method, this loan would take 2.5 years less to pay off and cost almost £7,000 less in interest, which is an enormous difference. Even if your credit rating wasn't excellent and was okay to sort of fare, and you were able to get a £10,000 loan with an interest rate of 9.9%, this would cost you sort of £210 a month in repayments over 5 years, and cost you £2,594.46 in interest, which is still over £5,000 less in interest than the avalanche method from the previous example. So those examples show how much cheaper and quicker paying off credit card debt can be with a loan. But before you go and start applying for loans, it's important to do a soft application or a soft check to see whether you're likely to be accepted for a loan. You don't want to actually apply for a loan and get rejected, because if you do that, it will leave a mark on your credit history, and it will affect your ability to take out credit in the future, to apply for a loan in the future. So you want to go to a website like Money Saving Expert and do one of their soft market searches for loans to see what you're likely to be accepted for. Now, I'll leave a link in the description to this video below to where you can actually carry out these soft searches that won't leave a mark on your sort of credit history and won't affect your ability to apply for a loan when you're actually ready to. So finally, the cheapest method for paying off your credit card is likely going to be moving it via balance transfer to another credit card with a long 0% interest period. The key thing to remember with these credit cards is that although you have an interest-free period on the card, there will be a charge to move the outstanding debt from one card to another. There will be a transfer fee. From the searches I did online, I saw that this fee could be as low as 2.85%. This fee is still likely to be a lot less than the interest you'll pay on a credit card if you don't move it. But it's something to factor in when you're doing your calculations. From the searches I did online, the longest 0% interest period I could find on a credit card with a balance transfer facility was 28 months and had a transfer fee of 2.85%, which is the fixed fee they charge you to transfer the outstanding balance from one card to the other. Now, if you were to transfer the balance on credit card 1 of £5,000 to this card, it would cost you a transfer fee of £142.50, which is 2.85% of 5,000. If you were then to pay off the outstanding balance of £5,142.50, which is the initial balance of £5,000 plus the transfer fee of £142.50 over 28 months, this would cost you £183.66 a month, and it wouldn't cost you any more interest other than the initial £142.50 in transfer fee. This means this method would be £1,241 cheaper than not transferring the £5,000 to the new card with a 0% interest period and just paying off directly. and £216.79 cheaper than the credit card one portion of the loan with the 2.8% interest. Just like applying for a loan, if you're going to apply for a credit card with a 0% interest period and take advantage of this method, it's very important that you do a soft search before you actually apply for the credit card, because you need to sort of find out whether it's likely that you're going to be accepted for the credit card that you want to apply for before you actually apply. If you apply and you're rejected, it's going to leave a mark on your credit history, and this could affect your chances of securing another credit card with a 0% interest period that you would have otherwise been accepted for. So do the soft search first before you actually apply for a credit card or a loan. And I'll leave a link in my description to a website, the Money Saving Expert website, where you can actually do a soft search and see what sort of loan deals or credit card deals you're likely to be accepted for before you actually apply. Now, my final thoughts on paying off debt fast. I think personally, the best way to sort of pay off your debts, if you've got a decent credit rating, if you've got a decent credit score, is to take out a loan to pay off your credit cards, rather than sort of moving it to a cheaper credit card, or even paying it off directly. Now, this is because with a loan, you can't take out any more credit. Once you take out a loan and you pay off your credit cards, you're just paying back the loan, and you can't use that loan to buy anything else. With credit cards, however, even if you're paying them down and you're doing really well, if you slip up and you decide to go on a shopping spree, then the outstanding balance is going to increase on those credit cards again, and you could easily end up in the situation you were in at the start. So when you have a loan, however, you can't do that. You take out a loan, you pay off the credit cards, and then you just left paying back the loan. There's no more credit for you to take out without applying for another loan, which is much more of a barrier than having a credit card. The only problem that you have with a loan, which you don't have with a credit card, is that you can't overpay a loan. You can't pay it back quicker than the initial agreed period without facing a penalty. Well, that's the case in many situations. With a credit card, you can pay it off usually as quickly as you like without being penalised for paying it back early. But with loans, there's very few loans that you can actually pay back early without facing an early penalty charge. I did have a search online, however, and I did come across a loan that you could take out for £10,000, which had an interest rate of 2.9%, so not much more than the one we had in the example, and allows you to actually pay it off early without any additional charges. If you're actually in need for a loan and you're interested in it, I'll leave a link down in the description to it so you can have a look at it and see if it's something for you. So that brings us to the end of the video. I hope you enjoyed it. I hope you found value in it. If you did, please like. If you haven't already subscribed, please do. And if you know anyone that would find the content of this video useful, please share it with them. Good luck on paying down your debt.